Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 305 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of the financial markets and financial planning. This week, I will be running the podcast solo. So this is going to be a fun one. I got Jenna here producing the podcast, my support here, and we're ready to do this. So before we get into the normal format of the podcast, listeners, if you've been enjoying the Independent Advisors Podcast for a while now and want to take the next steps in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. We make scheduling very easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select the time that works best for you. We have a quick survey to fill out, help us guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As we transition, as always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from stockcharts.com and is as of the market close on the 18th. Yesterday was a federal holiday for Juneteenth. S&P 500 index year-to-date up 1.69%, month-to-date up 1.17%. The Dow Jones Industrial Average year-to-date up 88 basis points, that's 0.88%. And month-to-date down 23 basis points, negative 0.23. NASDAQ Composite up 1.22% year-to-date, month-to-date up 2.26%. The IWM ETF that tracks the Russell 2000 Small Cap Index, year-to-date down 4.64%, month-to-date up 2.25%. On to fixed income bond land, the 3-month yield on treasuries. This data is as of 9:30 a.m. on June 20th. The 3-month is sitting at 4.33%. The 2-year yield sits at 3.946%, and the 10-year sits at 4.419%. As we transition, as usually, to big headlines and current events, obviously the geopolitical headlines remain fluid with the ongoing Israel-Iran conflict dominating the headlines that continued obviously throughout this week. The markets handled this uncertainty quite well, and that's evidenced by the fact that the S&P is up 0.1% through Wednesday evening's market close. These concerns, obviously, for the market are still in place, but they are being pushed to the back burner after President Trump said that he will decide on an approach to Iran over the next couple of weeks. Moving on from the geopolitical side of it, let's talk about the Fed. So the Federal Reserve is keeping its benchmark Fed funds rate steady at the 4.25% to 4.5%. It announced that after its 2-day meeting on the afternoon of June 18th at 2 p.m. in its policy meeting. As a reminder for our newer listeners and viewers, the Fed has these meetings planned every 6 weeks, so the next one will be at the very tail end of July. Continuing, the Fed says it's continuing its cautious wait-and-see stance amid solid economic growth, low unemployment around 4.2%, and inflation risks tied to the Trump-era tariffs. In its updated economic projections, the Fed cut its 2025 GDP growth forecast to 1.4%. and raised its year-end inflation outlook to 3%, and expects unemployment to end the year around 4.5%. Though still anticipating 2 rate cuts in 2025, policymakers signaled that 7 of the 19 officials see no cuts as necessary, with Chair Powell emphasizing that any future adjustments will remain data-dependent, particularly in light of tariff-related inflation pressures. Here's my 2 cents on the topic. I get asked a lot about the Fed. I make this quite easy. You look at the lens of history. The longer the Fed, holds these rates and has a slower rate cut cycle, the better it is for risk assets through the lens of history. So, from my standpoint, I'm okay with this. I do think that the Fed will start the cutting cycle the second half of the year. That's the camp I'm in. To what magnitude, we will see. Moving on to tweets, articles, and research from the week. I know it's been a couple of weeks since I've been on the podcast. So listeners and viewers, me sifting through this information to find what I wanted to discuss. And in these pieces, making the cut was a tough decision. So here we go. First item. This piece is from Ryan Dietrich at Carson Investment Research. Underlying source here is FactSet on June 9th. It's a piece that's titled, Yet Another Sign This is a Bull Market. Jenna will put up this illustration for our YouTube viewers. This will be in our show notes and all of our social media sites for Jessup Wealth Management. Pick your poison, whether it's Facebook, LinkedIn, X, etc. You'll see these notes. And what Ryan does here is he's illustrating S&P 500 after 2-month gains of 20% or more going back to 1950 to now. Like, how many times has this occurred? And the data set has 6 instances where the market gained 20% or more in 2 months. And what happens after that? So the data set, I'm just going to go over the years, not the month and day. 1975, 1982, 1998, 2009, 2020, and 2025. And I'm showing my age here, Jenna. 3 of the data sets I've obviously been involved in the markets. I missed the 98 data set. I started in the industry as an intern in August of 99, so I missed that one by a year. But I'm starting to get older when these data sets just encompass my work history. Yet I digress. The interesting part about this, and the reason I picked it, is the forward returns on a 3-month basis, on average, are still quite healthy, 12.5%. And then 6 months forward, 16.3%, and 12 months, 30.8%. It's interesting. It's very interesting, and I think that the reason I picked this is for a lot of investors, it is human nature for us to want to buy stuff that's on sale. I get that. But I feel what tends to happen in the market is a lot of momentum buying. And I think the market right now, in spite of some uncertainty and some of the headlines, take even the geopolitical headlines over the past week, continues to buck that trend. And I think that's something that needs to be noted. Second factor at play. We're sitting here on June 20th. I do think you're going to have a month-end melt up into the quarter, a little bit of what I call window dressing. There's, I think, a lot of Wall Street firms, if you do some Google searches, that were very negative on the market at the end of March and beginning of April. It's no secret. And I think a lot of that cash, I feel, if things continue as is, they could be forced to buy back in at higher prices. And I think the last thing a lot of firms are going to want is clients getting statements at the beginning of July showing abundant cash levels. So you could see people buying equities just for the facade of it, i.e. window dressing, going into the end of the quarter. So far, dip buying's been very consistent. So any sort of dip, no matter the reason, tends to get bought relatively quickly right now. And going back to my saying for our longtime listeners, that's not bearish. Next item I have is a post by Cebu Trade on June 6th. This is a piece that talks about the NASDAQ 100 rallies from when the index is down 20% below a one-year high to negative 2% below a one-year high within 50 trading days. It's a similar stat to what Ryan Dietrich did for the S&P 500, very similar, but encompasses the NASDAQ 100. This, again, will be put up now for our YouTube viewers. Jenna will have this in our show notes for all of our traditional podcast listeners. I'll verbalize this. And what you're going to notice is the data set for this is expanded by 1. So the years in which this occurred, 1991, 98, 2003, 2009, 2020, 2023, and here in 2025. It got triggered on June 6th. what you're going to see is the average return 1 month later, 7.33%, 100% positivity rate. 3 months later, 17.29, 100% positivity rate. 6 months later, 22% and some change. 9 months later, 29.57 with 100% positivity rate. And 1 year later, 42 even with 100% positivity rate. You know, I'm almost concerned to sit there and say the positivity rate of 100% because, you know, that's not guaranteed, of course, right? But looking at just the lens of history and why I selected this, the strength that we've seen in the market, when you look at the lens of history, tends to point to some degree, and we don't know how much, of strength in the future, you know, several quarters down the road. You know, this could be the first data set that's negative in this. It very much could be. But again, through the lens of history, that's not a bearish statistic. So let's go to one of my next favorite canaries in the coal mine. The source of this one is definitely the one and only Mark McKevely. Mark had a piece, he wasn't able to make the podcast today, that I kept, and it was what we call the Barron's magazine cover for June. And for our regular listeners, what we tend to see from Wall Street is when something hits the cover of the magazine, you tend to be at the peak. You tend to be at the peak point of the narrative. And the reason this is important to highlight is when this stuff hits the front of the magazine, I'd argue a lot of that stuff tends to be priced in. You know, I pride ourselves here on the Independent Advisories podcast of talking about topics that you're going to hear and see in the coming months and quarters. I think we do a pretty good job previewing what we see on the horizon. And I think with a lot of the magazine covers, it tends to be a little bit more clickbait-ish. What Barron's had on the front, and Jenna will have this illustration now for our YouTube viewers. This will be in our show notes. At the top of Barron's, it says, in bold, the S&P 500 just hit 6,000. Start worrying, page 22. Now, I know that's designed to sell Barron's. I get that. But when you see such things as that, that's a contrarian indicator for me, right? So it always has been. I find it interesting that it's on there. You know, I love when the market's climbing the classic wall of worry. All right, let's transition. Item number 4. Market return difference between trading during the day versus overnight. Follow me with this one. A friend of the podcast, Seth Golden, had a good piece on this. He posted on X on June 17th. I will now read what Seth put in his post. Jenna will put up this illustration for our YouTube viewers. His chart that I will be referencing will be in our show notes. Quote, unlike recent years, where all of S&P 500 gains occurred overnight, and most selling occurred during the trading day since the March period, March of this year, all of the losses are occurring overnight. All of the gains during the day. Best buy the dip regime in 3 years is what Seth said. Buy the open, sell the close. Don't fight the trend. Know what the masses are doing. Contrarianism doesn't benefit. So Jenna will put up this illustration for our YouTube viewers. Again, this will be in our show notes. What it's doing is it's showing the returns of the S&P during the trading day, what happens to the index overnight, and then just kind of the daily chart. And what this says to me is that the market is a lot more volatile right now. The futures market specifically, when the market's not open. It's a more illiquid market. It allows people to speculate or hedge in the futures market, is mainly institutions on Wall Street doing this. And I think it has, at least since March, proven to be a relatively inaccurate indicator, actually, of risk. I have seen instances, especially since February, where the futures will indicate, some of the times in March and April is indicating that they were down, you know, I'm talking 3, 4, 5%. And the market ended up drastically better that specific trading day. So my words of wisdom here is keep your long-term focus. Most of the listeners and viewers of the Independent Advisors podcast have a long-term investment time horizon. There's a lot of noise right now in the market. And I think you got to do the best you can to set that aside and be focused more on the long term. But quite an interesting observation by Seth that the market tends to be, opening up low and rallying throughout the day. There's a Cliff Notes version of that piece. Quite interesting. All right, changing gears pretty drastically. The next topic I have is an update on the U.S. dollar. This piece is from Mark Unwitter. He posted this. Let me see if I can get the date. With me doing the podcast solo. The date was in this past week, June 17th. And Mark posted this chart. And what he did, it's pretty smart. He took a chart from the Fidelity Manager Survey, FMS. They produce this monthly. It's, to be more specific, it's the Bank of America Global Fund Manager Survey, not Fidelity. I apologize. And this shows the chart from the survey, the percentage of money managers saying they're overweight the U.S. dollar. Well, it's showing a drastic underweight you're going to see here on the chart that Jenna's going to put up for our YouTube viewers. And this will be in our show notes. But what it shows is a lot of bearishness and underweight right now with the dollar. And what Mark did is he overlaid it with an actual chart of the U.S. dollar index. The ticker for most charting systems is $USD. And so my comments are, market participants are shorting the U.S. dollar at an unprecedented rate. And Jenna, for the record, I used unprecedented in an accurate way. Setting new records for bearish positioning. This raises a critical question. Does this reflect peak pessimism, presenting a potential buying opportunity as seen in 2004? Or does it signal the onset of a longer-term trend? It's no secret that the weakening dollar over the short term is definitely, I think, helping the administration's goals economically and tariff-related. But there's a lot of positioning that the dollar, by institutions, that the dollar could go lower, and it's definitely something I want to watch. But it's also not an area I would advocate for investors, especially our average listener on the Independent Advisors podcast. This is not an area I would be speculating in. These currency markets, they can move quickly, but you can see when traditionally on Wall Street, when it's such a one-sided trade, this is my disclaimer, I tend to get a little concerned that it can switch pretty quick. And people might be forced to buy back in the dollar, and it could have a pretty fierce rally. Could take a while. Just be careful in that area. But the dollar's weak, so if you travel internationally, the U.S. dollar will not go as far as it did before. One final stat I have for this week. This one is from Bespoke Investment Group. We reference Bespoke a lot. Great research over there. This was posted by them on June 15th. And what it shows is the S&P 500 performance after near bear market lows going back to 1945 to 2025. I know our traditional podcast listeners can't see my fictitious air quotes to the near bear market. And what Bespoke is referencing before I talk about the chart is the technical definition of a bear market is a 20% correction from a high water mark, but it has to be on a closing basis. And so the market technically sold off more than 20% on an intraday basis, but it did not on a closing market basis. And so the data set on this is 7 instances. I'm going to start giving some examples. Jenna will put up this illustration for YouTube. I will verbalize for our traditional podcast listeners. So let's go through some examples. Let's start with the first one. March 6th of 1978. The market was down 19.4%. So it was 0.6% away from the technical definition of a bear market. And in the first 45 trading days, the index rebounded 10.4%. And then let's go to the next data set, October of 1990, Iraq War. The index 19.9 missed the technical bear market definition by 0.1. First 45 trading days rebounded 10.6%. So there's multiples of these, 98, 02, 2011, 2018, and then the trigger for here was technically April 8th of 2025. Just so you get your feet under yourself, that number for the April 8th of 2025 on a closing basis, the S&P was down 18.9%, was the technical high water mark to low water mark closing basis. Now, when we look at the lens of history in these other data sets, the other 6, the forward after 6 months is up 9.5%. I apologize. Yes, 9.5%. And for the next 12 months, up 19.4 on average. The max loss the next 12 months was down negative 4.4. So again, why am I referencing this? Through the lens of history, I know we're seeing a lot of headlines right now. It could be geopolitical, it could be economic. You could be sitting there and thinking to yourself, oh, this has never happened before. How's the market going to react to this? And I think you got to look at the lens of history here. And through the first quarter earnings, which were reported in April and May, the S&P 500 has had 9 consecutive quarters of EPS growth. And I think you got to look at how equities have been trading over the past couple of months since the market low in early April. Price action is telling you something right now. The lens of history is telling you something. And the more the market is able to stabilize and have good price action in the face of some concerning geopolitical headlines, you got to pay attention to that. So that's my mini TED Talk of the day, my market update. I think you can read between the lines. Obviously, you got to continue to have a long-term investment time horizon. Not every week, quarter, or year is going to be positive for the equity markets, but they've been a phenomenal wealth generator throughout the years and decades. I'm going to skip the financial planning topic of the week. I'm glad that you were able to join us for an abbreviated Independent Advisors podcast during this week where we have a federal holiday. So thank you, everyone, for listening to episode 305 of the Independent Advisors podcast. Keep those questions coming, inquiries at jessupwealthmanagement.com. And we'll be back with you next week for episode 306. It is going to be an interesting interview that Mark McEvely is moderating, and we'll let Mark and Jenna give you more of those details next week. Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.